Hi, everybody. This is Victoria MYSIN. I'm a realtor here in the Sacramento area at Guide Real Estate. We're here today to talk about the latest and greatest questions I'm getting from my clients about real estate and real estate financing. To help me answer all those questions, I wanted to introduce the founder of the Vanguard Mortgage Group, Yuri Batarenko.
Hi, Victoria.
Hi, welcome. How you doing?
Thank you.
Awesome. Well, okay, let's just jump into it. First question, should you be afraid of negative amortization in mortgages? So that's kind of coming up a bit more. A lot of questions about it. What are your thoughts on that?
Well, yes, first let's define what negative amortization is, and then we'll see if it's necessary to afraid, if it's like better to afraid. So
Yes.
should we be afraid?
Know what it is before we know if we should be afraid of it.
Correct. So basically what amortization is how the principal diminishes with the time. So we all know that initially you pay much more interest, like a borrower pays much more interest on the mortgage and very little of principal. But with the time, that proportion changes and it becomes more of principal getting paid every month, right? So the way that principal diminishes and by the end of with the last payment it disappears, that is called amortization. So fully amortized loan, meaning that within 30 years this loan will be paid off completely and there won't be any principal left. So, but opposite of that would be negative amortization. It's actually when the principal balance with the time increases. Right? It sounds awkward, but there are special types of mortgages that do provide for that, and those appear especially in times when the affordability for the mortgages gets lower, when income is not enough to support payments for the mortgage. So banks come up with the different solutions and plans as how to help people, well, basically not to help people, but to make money in the environment where it's hard to make money. So they offer products that are not as great and straightforward as a traditional 30-year mortgage, but that does allow a person to buy the property. It might be good fit, it might be not good fit for the client, and that is that's what specialists are for, to help to determine. But basically, what happens with the negative amortization mortgages is a bank offers initial lower payment, let's say for the period of 3 years, to diminish interest payment, right? So for the first 3 years, so the affordability is higher, and it's for 3 years, so it's considered that 36 months. That's what Fannie Mae and Freddie Mac are looking for the period of 36 months. So that's what banks give. They give ability to be able to afford mortgage within this period of time, but then unpaid interest goes to the principal and it starts to increase it. So at the end of the term, where there is a certain certain provision to pay less interest, at the end of that term, when it ends, then the client gets hit with the higher payment because the principal increased. So these
and they do it in hopes that our clients will be making more in a certain amount?
Right. They do it, yes, because there are a number of reasons. It's typically that happens in a higher rate environment when the rates are high, so the affordability is lower because again, interest is a huge chunk of the payment, right? So by lowering, they offer these products with the lower interest for the certain period of time, and then some interest relief where the interest underpaid interest rolls back into the mortgage. So the person pays lower interest for the first number of years, right? But then the principal increases. So yes, banks do that to be competitive and to be able to offer loans in a high interest environment, right? There is also hope that interest rates will go lower and then the borrower will be able to refinance. That's the hope for the borrower. Banks don't care much about it. Also, the borrower may be in the hope that they will be getting higher income after a certain time, because maybe they just started their job and then they know that in 3 years they will
Right.
get
So
promotions.
I'll be in a better place in 3 years. Let me get this
Right.
mortgage to buy this house now. And then, yeah,
Correct.
that makes sense. And how does it work with refinancing? Is there any rules on refinancing if you have a negative?
No, typically no. I mean, that is the product that you wouldn't see this product common because they are getting regulated higher and then they get more scrutinized. So we didn't see these products for a while because again we were in a low rate environment. Now we are getting into high rate environment. Maybe we will see more of those, but again, I have not seen any of these for a number of years, and I don't think they're going to be reappearing. So again, and each case will be individual. I would not personally recommend those, but again,
Right.
all depends on the situation that the borrower is in, and if they do anticipate increase in the income, and we anticipate that the rate will drop, and then it might be a good solution.
Okay. Yeah.
Right,
So
and
for example, you don't recommend.
it's individual. So this
Right.
is
Right.
I
It
would
is.
not recommend to study on your own and take a decision. I would recommend to consult with the specialist to see if it's a good fit or not, because this might
Specialists like you,
right. Thank you, thank you. But it might be dangerous if
Yeah.
if things are not good by the end of the term that you'll have to pay full interest, then
Right.
it's not going to look good.
Yeah. Could be potentially a huge problem.
And my question to you, when I first started doing mortgages in California, I came across some other fees that are being collected and have to be accounted for actually in the payment. I mean, traditionally we have principal, interest, tax, insurance, but in
Right.
California, I know there are some other fees. Can you?
California's, yeah.
It can affect DTI sometimes significantly, and it's something to
Exactly. Yeah, I mean, California, of course, has its own special rules for everything. Mortgage payments are not excluded. So
Well,
for that, there's a few things to look at. There's a few things that are kind of common to all mortgages. A few things that I tell my clients to look at is, first off, is PMI, private mortgage insurance, and that's if your mortgage payment is, or your down payment is less than 20%. And Yuri, chime in if you have any thoughts on that. And that's kind of, and I think that'll range anywhere from about, I think, 75 to up to $300. Is that right? It just depends on the price of the home.
yeah, well, yes, mortgage insurance. It depends on two main factors affect mortgage insurance. First, its amount of down payment. It's going to be a huge difference between in mortgage insurance between down payment 3.5% and 5%. Right?
Yeah.
1.5% difference in down payment, but that can double up your mortgage insurance. In one case, it can be about 200. In another case, it could be 350. So yeah,
that's significant.
more than 350. And another thing that affects it is a credit score, borrower's credit score. These are two main factors.
Yeah. So that's really, that's something I really tell my clients to look at. And sometimes we just get these mortgage calculators that tell you your payment amount and your principal amount, and that's really not a wholesome look at it. So PMI is one thing, which we just said. The second thing is HOA. So depending, homeowners association fees. So that's if you live in a specific neighborhood that has that. And that also can vary significantly. So something to keep in mind when you're looking at a house. And then something that's specific to California is Mello-Roos. So the Mello-Roos tax is a special tax assessment district created in California to finance local infrastructure services. So like schools, fire departments, all those different things that are needed in a new neighborhood. So that's typically where we see that, and that could be up to 20 to 40 years that you have to pay that Mello-Roos tax, and some of those, payments, and I think some of them are about $3,500 a year, so about $300 to $350 a year for the next 20 years, let's say. So if you're not calculating that in your payment, and a lot of times it won't come up until your mortgage professional helps you with that based on the zip code, based on, the neighborhood. So really important to look at, because of course that can make or break your payment, like you're saying, and it definitely increases or makes a difference in your DTI for sure. So those really three things, along with all those other things, is something I really kind of hone in on that with my clients. Yeah. So next question for you. Does it make sense to finance your purchase in a rising interest rate environment? So everything's, shifting. This is like a question I'm getting a lot. So
Right,
what are your
because
thoughts?
I mean, we are in a rising interest rate environment now, so a lot of
It's
people
up and
actually,
down. It's been very flexible, so it's been interesting to watch.
right. So
Yeah.
my answer straight away, it's a solid yes, and
Okay.
I'll explain why. It does not make sense to me to buy in a falling interest rates environment, because if they are falling, then in a month time you can get a better deal, right? Because let's say right now you're getting it at 4% mortgage, and then a month later it could be 3.5%, right? So you would be
Exactly.
biting your elbows, like, why didn't I wait half a month and I would get a better deal, save $200 per month on my payment, right? So that is questionable, right? If it makes sense to buy in a falling interest rate environment or not, right? That's decision of every person if they need to buy or not. But when the interest rates are rising, my answer is solid yes, because if you buy in today, and no matter what the rate is, even if it's 6% today, right? Tomorrow or 2 weeks later, it could be 6.5%, and then 3 months later, it could be 7.5%, right? And you locked in at 6%. I mean, you are benefiting, right? So it's not like you're going to be losing money. So those people that will be buying later, they will be paying higher premium, they will be paying more interest. Now, the question here is, will rising interest rate affect the market and drop the price of real estate? And that is not as easy to answer as to should I be buying, because if obviously if you buy today at 500,000 and then 3 months later the property costs 450, obviously not going to be happy about that. But again, in my understanding, what is happening at the moment, rising interest rates are not going to really drop down the housing prices, because it also has to do with the inflation. Yes, it will diminish demand a little bit, but because of the inflation, sellers would not want to decrease the price, because again, they have equity, they don't want to sell at loss, so they hold the prices.
Right. Yeah, and that kind of, you know, the cost to build the same home goes up. So I mean,
Correct. Exactly.
it affects it.
Ultimately, look at it this way. So yes, and there is always demand. There is population. Like we are immigration country, right? So a lot of people desire to come here. So we do have influx of people. More and like a lot of people coming in. So they all do need housing. And again, the cost of construction rises. So the builder is not going to build and sell at loss. It doesn't make sense, right? So they.
Exactly.
Yeah, so it will balance out obviously the existing housing. So builders won't build at loss. So the demand on the existing housing market will raise the prices, or we will stabilize the prices.
Yeah. Yeah.
So when the interest rates are rising, yes, that would be for me it would be a solid yes to buy in the interest rate, because if they will fall, then you will have advantage of refinancing. But if they will keep rising and nobody knows how long they're going to stay high, then you will be benefiting by locking in lower rate.
Right.
So, and then out of this conversation, I have a question
Okay.
for you regarding real estate on the current situation. What are your thoughts, and does it make sense to finance your to finance the purchase in your opinion?
Yeah. I mean, that's the hot question we're getting, is that should I buy a home now, or should I buy, or should I wait? So, I mean, just based off of everything you said, I mean, and I'll just add to that is that, I mean, it really goes back to a reason of why you need to buy a house. I mean, is it an absolute necessary thing for you to do? Is it a long-term investment? Then I would definitely say yes, go for it right now. It's you're going to be in that house for more than a few years. It makes sense. And then who knows what will happen later? Maybe interest rates will rise, maybe interest rates will fall. But in any case, you'll have the house. It's a long term. You won't. In the end, real estate is always a great investment. I mean, you look over the last 100 years. It's always a great investment. I mean, that's how all the top financial experts teach to build wealth. So it's now or later, it'll still balance out. I mean, even people that bought
it. If we look at rich people portfolio, they all do have real estate holdings, and they are.
Yeah.
I mean, they are not flipping houses, right? They hold and not only houses, but commercial real estate also. But what is also important,
Huh? What was that?
I did want to mention.
Okay. Yeah.
I forgot.
Yeah. Got it. Yeah, I was gonna say that best investment on earth is earth. So I heard that somewhere. It really stuck with me. I'm like, yes, it is. But yeah, so we covered some great things today. Really appreciate you being on here with us. Yuri, you've been amazing. Thank you for your expertise.
Thank you.
And thank you everyone for joining us.
I'll remember next time what I was going to say, and I got distracted by something.
It's okay. Yeah, we'll save that tidbit for next time.
Right. Pleasure being here. See
Thanks,
you.
everyone.